bad joke. Dropped at the first sign of trouble. They're only as good as the world allows them to be. I'll show you. When the chips are down, these civilized people, they'll eat each other. See, I'm not a monster. I'm just ahead of the curve.
What is going on, YouTube? It is Dr. Death from Market Makers, guiding you through this pattern of decay. I am not a monster. What did you guys think about that intro? Let me know if you like it. I know everybody loves the dance music one, okay? But we get demonetized when we play these videos all the time, guys. Today's video is going to be a special video. I'm going to explain the bubble cycle. We have about 1,000 new people joining the YouTube channel every single month. And I know people don't go back and watch old videos, so we'll start linking today's video at the end of our future videos, so you can come back as a reference point if you ever want to cover this. We're going to cover the bubble cycle, why I believe the market hasn't bottomed. We're going to look at the equities markets. We're going to look at a couple commodities. And of course, we're going to look at Bitcoin as well and go over some key concepts and all the targets, guys, where I believe these markets will end up. All in this video. And this video is going to be brought to you by SimpleFX. To trade all of the assets that we cover here in my channel, you can check out SimpleFX. The link is in the video description as well as pinned in the YouTube comments, as well as BingX, guys. That's a traditional crypto exchange that is also pinned in those same areas. By checking them out, if you are planning on trading, it helps support this channel. Really would appreciate it. Our exclusive bonuses and everything else, all the details are in the video description and available with our links. All right. Number one question. I saw a few people, or quite a few people, are confused on my screen, guys. The difference between an equinox pivot, that's the green line here, okay, the neon green lines, and then my S&P pattern. So to explain this to you in a bubble cycle, these are very important pivot dates, okay? In a bubble cycle. So the equinox pivots, if you envision time as a circle, the spring equinox would be 180 degrees on that circle, meaning a pivot, right? Changing direction. That's what a pivot is. So it would be 180 degrees, whereas the fall equinox, which happens in late September, that would be your 360 degrees, completion of the cycle. So the best way to explain it. So as an example on the chart, just from current charting here, okay? Just looking at this, let's just go back. Spring equinox 2022. Do you see how we had the spring equinox and then what happened? We had a few more candles form. It made the top reversal of trend and we dumped. Okay. So the equinox states are like red alerts, especially in a cycle of decay. They are red alerts that a change in trend is incoming. Now that can happen on the day of the equinox, like it did in March of 2000 for .com. The day of was the top and then it sold off. But traditionally, this happens within a week or two before or after this red alert flashes. So you see the trend change. And then again over here, September 2022 of this is the bottom forming. So you can see we had the fall equinox, and then what happened? We had a few more candles come down, guys, and then a little rally, and then the true bottom. So again, happened within a week or two of the fall equinox red alert signal. And so where we are over here in current time frame, the spring equinox, your red alert signal saying your change in trend is incoming, and that's where we are between the red alert and then this pattern that's been playing out here on the S&P of the 43-day pivots. So the key concept here is, as you can see from this base over here, we are in a continuous uptrend since the October bottom. Okay, again, October bottom, just after that fall equinox. We are in a key uptrend here. And the question is, for me, what I was trying to explain in yesterday's video, or 2 days ago, the video, was are we going to just go sideways, go up a little bit more before we hit the 14th and then dump, or are these selling programs going to kick in and we're just going to start dumping, making this a potential bottom pivot, something like this, come up, maybe make a local high and then come down again and then do this and then come back up. Okay, something like that. But what we know is a change in trend is incoming. That's what the equinox is telling you. Okay. That's what it's telling you. And so this is what we have to pay attention to, what price action is doing now. So it's a very key concept, guys. And why are these 43-day pivots important? I saw somebody said, "Oh, your 43-day pivots are stupid." That's what I love about YouTube. You get these intellectual commenters on the channel. They're stupid. Okay, well, let's look at let's look at why they're not stupid. Let's try to dumb this down. The 43-day pivot gave you the exact bottom, gave you the exact top, gave you the exact bottom, gave you the exact top, gave you within $20 of the exact top over here. So if that's stupid, you call it being stupid. I call this making money because I'm trading it along these pivots here. Okay. So this is very important and a key concept. So I'm marrying the equinox dates here together with the actual pivot pattern at play. Another good question somebody asked in the comments, can this pattern be invalidated? Yeah. Well, what would invalidate it? What would invalidate it is these future 43-day pivots not being a vital part of the conversation, meaning if price does start dropping here and hits the pivot and just drops more and doesn't reverse trend at all, like not even a little baby reversal, well, then, it may not have a lot of validity still. But again, this is a pattern that's been tracking true since June of 2022. And as you can see, and this is also where we traded it off of, guys, and got this key drop in confluence with additional TA. This is why we knew to trade here. This is why I knew to trade here. This is why I knew to trade here. So this is all very important when you start looking at this, okay? You got to put all these pieces of the puzzle together. Patterns are dynamic. Of course, they can change, but historically, when you have patterns that play out, you can land big trades as they continue to play out. And based off this pattern, again, and I'm going to explain the bubble concept because a lot of people are confused. Are you saying we're not going to a new bottom or we are going to a new bottom? I'll explain all that here on the next charts, okay? And I'm going to do it for Bitcoin as well. So again, according to this pattern, if it plays out throughout the rest of the year, October 12th, which would be right after the fall equinox, which I don't know off the top of my head. I think it's September 20th or 22nd. So let's just put it there. It's always within a few days at the same time period every year. So we'll put it right there. Just after the fall equinox, you come and make your bottom again. Just like Y2K, where you bottomed October 4th or 5th, and you had your fall equinox in September 20th to 23rd, somewhere in that time frame, okay? So that's what I'm looking at for the final bottom if the bubble pop pattern continues to play out, the boom bust bubble. Now, I want to show you guys something. We talked about this briefly yesterday. I was a little bit tired. I made that video so early, I guess 2 days ago when I made that video. I made that video so early for you guys. You could have it on Sunday, but I wanted to show you this again to make sure you understand what's happening here. Okay. So this again, last year, we're repeating. I've been showing you the .com pattern, right? We've been going over the .com pattern. I beat it to death in multiple videos for at least 2 weeks in a row. So you guys can watch that. We're still tracking exactly like the .com pattern. Just here on my screen on the current time frame, green candle, that was your spring equinox. This is your spring equinox in .com that gave you your local high and then you sold off, okay? We already hit that on this last weekly candle. So again, red alert sign, but I want to focus on last year's pattern, okay? Last year's pattern. So last year's pattern is very important because what did we do? Look at March 29th. Tuesday, March 29th was your local high before you had that first swing down that we covered last video, the first 20% down move to start our 43-day pivot cycle, okay? So March 29th, that's what, tomorrow? What is today, 28th? Yeah, so that's tomorrow. Anniversary dates can sometimes be very important in the marketplace. So I want you to pay attention to what happens here in the next couple of days, specifically tomorrow as well, because a year ago tomorrow, it provided our high. Now, something else you can do here in sequencing, guys, check this out. Date range. So if we look at this spring equinox, how it played out last year, it was Monday, March 21st last year. So let's go to that candle to the high, okay? 6 bars, 8 days. You see this? 6 bars, 8 days. So spring equinox, 6 bars later, 8 days later total, 6 trading days, 8 days total, and then we sold off 20%. So let's check out this spring equinox and see what happens with this, if this was to repeat. Okay, this is just a little pattern here. Spring equinox, let's go out 6 bars, 8 days. That's today's candle. Okay. So today's candle could be your local high, not the high. Obviously, there's candles before it higher. This could be your local high before you start selling. And again, I'm not saying that's what's going to happen, guys. This is a very small sample size, but it's just part of sequencing, looking to see if patterns repeat throughout the marketplace. Okay. So we know last April, again, last year's pattern rallied up into April or into March and the end of March, early April, and then we sold off, dropped 20%. Made our bottom in June, okay? Rallied up to August, made our bottom in October. This exact pattern is what I think is repeating right now because now we have the rally up from October. You can see it right here, this continuous rally, and we've rallied all the way up, and this is a 5-month long rally at this juncture. Okay, you can see our little pivot points here that provided these excellent trades. And where's this taking us to, guys? From October, it's taking us to the end of March, early April, and that's where we are right now. Whether we start dumping here or come out to that 43-day pivot and then dump, we have the red alert signal of the equinox, but we're repeating the exact same pattern. So if we do start selling off here, that means our April sell off or late March, early April sell off will give us the next bottom in June, just like June of 2022. Big rally back up. Okay. We have our big rally back up. We come out to August. And then what happens, guys? August, we sell off once again, and then you come down to your late September, early October bottom. Now, I want to show you this on the charts. The key takeaway here is we're repeating the exact same buying and selling cycle, the rally and decay cycle of last year, as well as these pivots play out. Let's go ahead and look at this at a bubble cycle perspective. Now, a lot of people are asking me, how did we get here to this bubble? Well, so basically, if you're under the age of 35, so I'm the tail end of Gen X and I'm 44. But if you're under the age of 35, you never actually went to school in the United States of America. You went to indoctrination camps. Because I have a daughter in university, and I can tell you, and I've had this experience, and a lot of you can relate that have kids. The school system here is horrible, and private schools they're still better than the government schools, but a lot of those, they're just not what they used to be either. But you can get through all of university, all of high school, and really not understand any economics. And then if you do that, you can have a successful career taking other people's money and getting the fees and working for Goldman Sachs. Okay. But guys, you have to understand. So what happened in .com? .com, we had basically the birth of the interventionist Fed. It really happened earlier than that with the 87 crash. Greenspan, I think, was on the job for a month at that point. But this is when the Fed became interventionist. Before, they used to just deal with like a crisis like Volcker. Volcker had, 13% inflation, jacked rates up to 20%. Other than that, do you know anything else about Volcker? No. But you know a lot about Powell, and you know a lot about Alan Greenspan and Ben Bernanke, because they try to cure all of the market's problems with more policies, and they keep making it worse. So starting in .com, we had an interventionist Fed, but really this came to a head essentially since the great financial crisis. This is when Ben Bernanke came out with the quantitative easing. He actually made that definition up as well. Quantitative easing, the TARP programs, the bank bailouts, letting some banks fail, changing laws so other banks could be bought up. And so we had, since the great financial crisis, we've had $30 trillion and 0% rates. Okay, so money was free to borrow. That's why you can have like ARK Investments, which has all of these super speculative tech stocks that don't make any money. Okay, so money was free. Well, what just happened now? $30 trillion gets thrown into here. We had the pandemic 2 years ago. Again, massive trillions and trillions more in the being sent out to individuals as well as being provided as liquidity in the marketplace. It all showed its head in the marketplace. And what do I mean by that? Well, we've been over these numbers before, guys, but here's your pandemic on the left. This is the S&P. S&P typically goes up 10 to 12% a year since the interventionist Fed, since the great financial crisis, 10 to 12%. We went over this, but you went up over 120%, guys. 121%. And how many candles was this? This was exactly, let me go ahead and get a date range on this. So weekly candles. So 651 days. So less than 2 years, you went up 121%, where normally you would have gone up cumulatively 20%. So do you understand that? You 6x your normal 2 year return. This is how you made the bubble. Now you can think it's not a bubble. You can think that's just a fluke. Whatever you want to think, it doesn't matter. It doesn't affect my personal trading. I'm telling you this for informational purposes. You went up 120% in 2 years, and you should have at best only gone up 10 or 20 to 22%. It's a bubble, okay? And also, for the first time in history, we have a housing bubble along with their equities bubble. Great financial crisis was a subprime housing crisis. But you have to understand, in this bubble now with housing, versus median household income, house prices are actually more expensive. And then we have a bond bubble, a debt market bubble. So you have a tri-pronged bubble, a trident bubble. This is the boom bust bubble. People are calling it, Jeremy Grantham calls it the super bubble. Other people call it the everything bubble because it involves so many different things. Japan's the only example I can give you, 1989, that had a housing bubble and an equities bubble. And both those markets to this day have still not made, over 30 years later, have still not made a new all-time high. Y2K, even by mainstream media, was considered an equities bubble. 1929, equities bubble. And great financial crisis, housing bubble. And now we're doing both of them at the same time. Sounds very dire. Well, yes, it is. Well, what are some attributes that happen in these bubbles that people call black swans? I don't know. Bank failures. We already had bank failures, the second and third largest bank failures in U.S. history. I do believe there will be more to come, but everything will start to appear priced in the marketplace. We have peak unemployment. I've showed you the unemployment chart again, leading to recessions. Lee, throw that chart up one more time. You guys have to understand, when you have low unemployment, peak cycle, we hit 3.4%. 3.4% was a 54-year low. Okay, look at the red line. That's your recession hitting, and then unemployment goes parabolic. So if you're watching people on TV and they say things like, I think where the jobs is too strong to have a recession, just turn them off, because there's a chart that can show you they don't have zero idea what they're talking about from a historical perspective. All right. And the other thing is, we need to talk about just a few things. We've talked about all the different indicators, but again, this is a reference video. Okay. We've talked about all the different indicators, why I can be so confident the market hasn't bottomed. And here's a couple of them off the top of my head. The Conference Board leading economic indicators. Whenever they've been at the level that they are now, it has 100% of the time signaled a recession. Okay. The 2 year yield has never spiked, had the peak spike in cycle prior to the market bottoming. Okay. And we just 2.5 weeks ago had the 2 year yield hit its peak spike, and the market made its bottom in October. So that's never happened. So we had the 2 year hit its spike. Now you're going to see another bottom come in the marketplace. As you guys know, the market has never bottomed ahead of a recession, ever ahead of a recession, and the market has never bottomed while the Fed is actively raising rates. Well, the market bottomed in October. The Fed has put in multiple rate hikes since October. Again, all of these things I just listed have a 100% track rate for proving that the bottom is not in. So if you want to go back to 1957, like I did here in this list, if you want to go back to 1957, over 70 years, and still say you think the bottom's in, that's fine. But what that would mean is every single indicator, including the yield curve inversion, which we had a 93% inversion, again, historically 100% hit rate for a recession. Every single indicator that's been 100% accurate for 70 years would have to be wrong for you to be right. So if you're going to go into a casino, do you want to go the way that's been 100%? Hey guys, this horse wins 100% of the time, all the time, ever since its history of this horse running professionally? Or do you want to run against a long shot that's never even won a race ever? Well, the odds pay off a lot better on the long shot, but the smart money, where's that going, guys? With the track record. So that's what I'm doing when I give you these predictions. Now let's get to the targets. We're going to walk through the targets on the S&P, the NASDAQ, Bitcoin, and the DAX as well, the German 40, okay? Let's go ahead and look at this. So again, 3 phases to the boom bust bubble over here. Phase 1, denial, then bear market rally 1. Phase 2, FOMO. Fear of missing out. That's the big rally that'll be coming on this after this next wave down. Bear market rally 2. Phase 3 discussed, bear market rally 3 slash bottom. Okay, this is my take on Dow theory married with Fibonacci waves. And so what you can see here on the S&P, we got to phase 1 denial. This is not a bear market. This is a correction. How many times have you heard this on TV? How many crypto YouTubers keep talking about that? How many crypto YouTubers are saying things like, I'm super bullish on Bitcoin right now? Several of these big guys are still showing 500K targets, 1 million by the summer. This is all part of the denial phase. When this rolls over, okay, when this rolls over, which it will follow the equities market, when this rolls over here, the S&P is the equities market, but Bitcoin will follow the equities market. But when the S&P rolls over, guys, it's coming down to the next level. And again, 3141. This target for me again is 3141 to 3300, somewhere in that range. Okay, I have to give you the separation here. I'm basing this on a fib wave projection, and the 618 is phi. 1 is the geometric mean between phi and phi. Phi is the golden ratio, 1618. So that next level down, I'm looking at 3141, roughly a 35% drop at that point. That's FOMO. This, according to everybody on TV, guys, this will be the bottom. You can just turn it on. Even the bears say, guys, we have one more flush coming. When this flush comes, this is pricing in the recession. Because why, guys? Because historically, the S&P trades at a minus 34, 35% in the cycle when a recession comes from its high in that cycle. So this brings you down to that recession norm. Again, this is the rally to trade for the upside. This, once again, based on our S&P movements that we covered last video, could be another 20, 25% rally to the upside. So it'd be great to be in on that. This key here, after we come down and we rally, this is the key to whether or not this is a bubble. If this rally holds, you retest the base maybe at some point and that holds, then that could be your bottom, guys. And this, to me, in my opinion, is not a bubble. Why do I say that? Because every bubble historically has hit at least minus 50%. A lot of people don't consider the 72, 73 crash a bubble because of the external factors, oil crisis, all types of things. But so if you look at .com, we went minus 50% on the S&P, minus 84% on the NASDAQ. You look at the great financial crisis, again, minus 57% on the S&P. You look at 1929, far exceeded that. The early 70s, 72, 73, that was the largest break since 1929. I think the S&P lost 63%. So every single bubble has at least hit the 50% target. So for me, for this to be a bubble, you got to hit the 50% target, and you will know when you come down to the FOMO phase, if at some point this tops out and you sweep this low, it's a bubble. Now, my personal opinion, it's a bubble. You guys have heard me say this all the time, that I've been playing the clips of the different people that have studied these things, like Jeremy Grantham as well. This is a boom bust bubble, if you will, a super bubble, and I do believe you're going to exceed that. Now, on the S&P, guys, if this is the bubble of our lifetime, the everything bubble, I think you're going deeper than the 1618 at 2409. Like I told you guys before, Jeremy Grantham has 2000. I'm looking at 1888 to 2058, which coincidentally, perhaps not coincidentally, would basically give you fee 61% drawdown. Okay, so 50% makes it a bubble. Anything beyond that, because the market tends to overcorrect. I mean, that's just icing on the cake as far as super bubbles go. Guys, I don't see how it's not a super bubble when you have housing, when you have equities, and you have the bond market as well, all in a bubble. Okay, so this is what I'm thinking, and this is how I think it's going to play out. But again, this FOMO phase is where I want to trade the big rally. Let's go ahead and look at the NASDAQ. NASDAQ again, guys. Notice these fib levels will change based on the market and the asset that we're looking at, okay? So this hit the 486 fib. So could these be other levels in between here and it doesn't come down to that 50% on the next wave? And for the NASDAQ, I don't think it is coming down on this next wave necessarily to that. So you have to look at your other fibs, okay? But again, this is for the purpose of presentation of where this will go. When the NASDAQ rolls over and pulls down, you've already hit phase one denial minus 35%. The next level down, I'm looking at the 786 here, 9,200 to 9,500 for your next potential bottom. However, once you get to 79.89, that's your 50%, okay? So that's why this is here. And if the NASDAQ continues to go down, the discuss phase is minus 75%. And that is the golden ratio, 1618. That is the NASDAQ, by the way, at 4,446, minus 75%. And I already know, especially some of you younger people that may be watching, that's so ridiculous. How can that be the bottom? How much did it go down in Y2K? 84%. How much did Amazon go down? 93%. This is not only possible, it is definitely probable if we sweep our low in the FOMO phase. Once everybody gets euphoric, whether it's at 92.95 or it comes down lower to 8,000 or just above, once everybody gets euphoric, if that euphoria fades and we have more crises come into the marketplace, people start selling, the economy gets worse. Remember, unemployment goes up at a ratio of 3.6% for every 2% that inflation comes down. So at that point, if we got to 2% inflation, you're talking about almost 11% unemployment. So tripling our unemployment, you could easily see how you can come down to this because, again, this is a historic norm here for the NASDAQ in a bubble cycle. Now, 89%, this would get the super bears. The super bears super excited. 1923 on the NASDAQ. What's realistic in my book? Again, the 1618, 4,446, and it could come somewhere between 79.89 and 4,446 and end up, say, at like the 1272 fib or something, maybe a 65% drawdown, 70% drawdown. We have to see when we get candles. This is, again, to give you guys an idea of the key targets that we are looking at, okay? Let's go ahead and look at this on the German 40. This is the DAX. You already got down to the 786. Your denial phase obviously triggered a strong rally. This is not a bear market. Strong rally almost came up to challenge your all-time high, and that was at 11,915 here, minus 27%. So again, same situation. Your one fib is only minus 32%, only a 5% difference. So on charts like this, I would look at my next key fib level for me, which is the 1272. That would be 10,000, okay? Now, if you start looking at where the DAX goes here, the golden ratio being 8,700, phase three discussed. If the FOMO rally fails, phase three discussed gives you that roughly 50% drop. And where do I think it would go? Well, this is going to be tied to the S&P. Why? Because they rally. Look at your October bottom. They rally and dump and confluence with each other. And a strong correlation between the DAX and the S&P. How strong? Well, the DAX actually went down 74% in .com. So maybe that correlation is actually more tied to the NASDAQ, okay? So 74% in .com, whereas the S&P only went down 50%. So these targets are wholly achievable because this bottom target of phase three discussed here, guys, only gets you to 7,000. Okay, and that's a minus 57% drop. So if the S&P drops 61%, you're definitely going to hit this. And these are all ifs. Okay, I want to repeat this because people don't always follow my complete video. These are all ifs based on what, guys? Based on the FOMO rally failing. Okay, coming up from FOMO, if you sweep that low and fail, I do believe you are tracking to the bubble, the everything bubble, the boom bust bubble. Okay, so the FOMO phase, which we have not hit yet in the indices, has not happened yet. These are your targets on the DAX. Now, the one you guys have been waiting for, but you've seen this many, many times already, Bitcoin. Bitcoin, I didn't use a fib wave. I used an impulse wave here with just a simple fib retracement. Okay, because this gives you some accurate targets based on what I'm seeing when I lay my fibs out. And looking at this, guys, we already got the phase one denial. As you can see, look at that 50% drawdown, 886 fib, 33,807. Phase one denial. This isn't a bear market. This is when everybody said, oh, this is normal, just a correction, still going to 250K. Don't worry about it, right? Still going to 250K. And this is also where I shared that massive trade at 48.2 for a 64% drop based off of as well what? Dante's Descent, okay? And so this is where we got to now. And now we fell to this 75% range, which is what? The FOMO. I mean, how awesome is this that this literally plays out in the media and on crypto YouTube? FOMO phase, right? And you have the $1 million videos coming out. You have people projecting, well, this is what Bitcoin was made for. It's an inflation hedge. It's going to go parabolic. I can easily see, 250K people wearing masks or hiding. They turn their webcam off and they're like, guys, you have to see this, and rocket ships on the thumbnails. This is FOMO phase. This is, see, we're not in a bear market, or Bitcoin's accumulated long enough. Now it's ready to rocket shit up. I'm super bullish on Bitcoin. Well, guys, we'll go over that in the NASDAQ chart again, but this is Bitcoin's fintech, okay? You can love Bitcoin, hate Bitcoin. I don't have an opinion on it from that perspective. It's fintech and it tracks to the NASDAQ. NASDAQ rolls, this thing's coming down. You hit the FOMO phase. When you sweep your low in FOMO, which is 15.5, and again, just like with some of the other assets, we need an extra fib in here because you're not going from 27K to 46.27, which is phase 3 discussed minus 93%. And I do believe this number will get hit between 4,000 and 8,000 is where I think Bitcoin's going. I've said that over and over again based on the bottoming cycle, guys. So this could lead equity. So if we have the S&P bottoming in October, that early to mid October, Bitcoin could bottom in August, could bottom in September, could bottom after. This is the prediction part. We don't have candles. There's no candles out here. This is months away, okay? So we're basing this off of cycles is how I'm giving you these predictions. But this here, let's go ahead and add another fib so we can see this. If we add, what do we need here? The 1414, maybe, and the 1272. So let's add the 1414. This is that target I've been giving you guys. I said 12.8, 13K Bitcoin for the next wave down, okay? This says 12,759. So this is where I think you'll get your next FOMO rally from. Because remember, Bitcoin is more parabolic. So whereas the indices are coming down to FOMO, Bitcoin's in FOMO, coming down for a second FOMO. Kind of like the same way it came up for 2 all-time highs, and the equities did not do that, okay? It came up for 2 all-time highs and then came down, okay, and then sold off. So I think you're going to that high 12s, low 13s on this next pull down. And when will that occur? That will occur when the NASDAQ rolls. But again, final resting place, 4,000, 8,000 later part of this year. Could happen before our October equities bottoming day. And this is what I'm talking about with Bitcoin, guys. I don't share this with you for you to get upset and type mean things, nasty things in the YouTube comments. I share this because some people actually care about correlations when you're trading, okay? Bitcoin and NASDAQ, 95% correlation. Look at other than the fact they made their all-time highs a week apart from each other. Look at the peaks, but look at just the current time frame here, guys, just for this year, 2023. Look at your double bottom in Bitcoin in orange, your double bottom in the NASDAQ. Look at your push up and your rollover down. Your push up, your rollover down. It's a 95% correlation. Do you understand what that means? What that means is when NASDAQ rolls down, especially when it comes down to that 9,500 target, 9,200 target on that wave, guys, Bitcoin will be sweeping its low, and that's when you'll see it go to that 12.8, 13K level, okay? Then your FOMO rally, your second FOMO rally for Bitcoin, first FOMO rally for the equities. If the FOMO rally fails, then you're sweeping your low and you're going back and then you're officially in a bubble in equities. I mean, you could say the Bitcoin bubble because it's speculative tech is separate, but it's going to track with it, guys. I mean, let's look at Bitcoin. Let's just jump into the TA now. 32 minutes in. You guys that like the long videos will like this. You guys that hate the long videos are screaming at me right now. But this is the daily chart, guys. We've had this laid out forever. We've had awesome trades based off these drops, right? 20+% move, 13.5% move off of these shorts with the Kepler's triangle pattern that I shared with you. Have this pump up. But when I look at this chart, guys, again, I gave you this target before we pumped up to it, 27,821. We pumped up to it, and that's where you're getting rejected right now. Now, this is all going to depend what Bitcoin does here is what happens with the NASDAQ, what happens with equities. Earnings will start here in early April. Again, this week is key to see if we continue to sell off, or if we get a little rally back up. But you want to always look for shapes and look for potential. Again, that double top. This is where you got your double top and it came back down to the neckline. Let's look at this on the 8-hour, get more candles. So this is the shape we were talking about last video. You're right down here at the base when I made that last video, and you try to rally back up and you fell back down to your neckline. Okay, so you zoom out to the larger time frames to look at your potential bearish structures that are being printed. If the market does want to push up a little bit, you want to see if Bitcoin can at least return to where it got from and where it came from. And if you see this in the bullish side of Bitcoin, would have to be coming up on top of this range of these candles, on top of 28.4, and pivoting out to the upside. And if it did that, it's doing that because the NASDAQ is rallying harder. Maybe earnings come in stronger than expected for some key companies or something, and you get some type of rally. But guys, the way it's trending now, based on this cycle, as well as last year, the rally and decay cycle of last year, you already had your red alert signal of the spring equinox signaling a change in trend is coming. So you want to look at Bitcoin, but really focus on the resistance areas of where you like to trade. If you guys do want to come trade with us and get a bunch of different signals from professional traders and other members as well. God, I'm talking too much. Other members as well. Check out our Discord. You do get to join for free if you try out SimpleFX or Bing, Messagely in the Telegram. All that info is pinned with the other stuff as well in the comments and in the video description. But again, so this key level that you're really looking at is at 28. Okay, so back on the daily, 27,821 candles above it. Bitcoin's parabolic. It can do that. You could see this double top really just form like this now. Maybe if you get a second rebound up. So just be aware of that. Look at that trading range. But again, you have to do this with confluence of what's happening in the equities markets. Okay, I would not do anything with Bitcoin without understanding what's happening in the equities markets because it's tracking so closely to the NASDAQ. Let's go ahead and go forward. Looking at the S&P. TA hasn't changed since last video, guys. As long as you're above the 200, which you are, you're at 39.68. The 200 is where we at 39.37. So you're about 30 bucks above the 200. As long as you're above the 200, you're below the 45, you're caught in this area here. So price can at some point be within striking distance of moving up, trying 40.80 is a key level I'm watching. Obviously, you're getting rejected at 40.12. You can see that you got above it, got rejected, all these candle closes below it. But watch your 40.12, your 40.80. And again, that pivot date, if we end up just banging our head here all the way out to April 14th, that pivot right there, if this keeps playing out, that's our pivot. That's our 43-day pivot, and that intersects perfectly with the 45 at 40.80. So that's a possibility. You could see this do that. Of course, you could also have a big sign of weakness and this thing falls apart. But as long as you're above the 200, again, this is the broadest, this is the strongest or biggest market, 34, 35 trillion market cap. This is still in a, there's upside risk here for an impulse move, even if it's only 60, 70, $80. 4,000, such a key psychological number to be stuck below. So you could see another attempt to try to break out into this level. So I'd watch 4,000, watch 40.80, 41.66, and then watch what happens when the earnings start coming out. At some point, the algos will kick in and start dumping. Okay, they will start dumping, especially if their earnings, the initial earnings, are coming in bad. Big banks are reporting first. Looking at the NASDAQ on the 3-day, still in this trading range. Again, this is a 3-day chart. So this is a little bit of a broader trading range. You have a support level here of 12,477, which you're kind of drifting down towards. We shorted this up here in the room. I shared that as well here on YouTube. I got in at 12,875, went up to 12,967, and now you're at 12,562. A lot of people still in this trade. What's the NASDAQ doing? Well, it's been a stronger performer than the S&P. A lot of rotation in the tech stocks. So right now, I mean, look at the double top. It's a beautiful double top, but again, it's not breaking down yet. There's no breakdown yet. This is a bearish engulfing candle at this juncture on the 3-day chart, but this is not breaking down yet. We'll see if this really starts getting some momentum later this week or early next week for a breakdown to see this come down and test this neckline at 11,788 and then really start moving. Guys, be aware markets do fall. faster than they rise. Typically 3 to 5 times faster they will fall, okay? So looking at the German 40, my levels are the same here, guys. You've spiked up a couple of times to 15.3. I really like 15.4. Does it sound nitpicking? Again, it depends if you're trading or not, okay? 15.4 strong resistance, and then 15.664. So anywhere between 15.4 and 15.6. I like this. The European markets are lagging. Your interest rates are lower, 3% versus our 5%, and you have higher inflation. So I think your fate in the European markets, and this can be the same whether we're talking about the FTSE, whether we're talking about the CAC, the French 40, whether we're talking about the DAX. I think the fate's the same, but it may take you longer to get there. So really be picky about, in my opinion, I would be really picky about where I would enter this trade, knowing that you could have some more up moves still in the basket. But again, this is highly correlated with the S&P, with the NASDAQ. Your rallies are the same. Your cycle of decay is the same. So be aware of that. So I like that 15.4, and I'll dabble if we get there. Some of the individual stocks we've been talking about. First Solar, again, up 257% since summer of last year. Massive move, gap move up here, printing a nice looking double top here. This is an asset I'm tracking and I'm actually trading, as well as we have this. Well, I guess I should cover the levels. So the levels here, guys, the closer you can get to 217, the better. 217 it hit a couple of times here, got a lot of supply dumped on it. Now it's kind of ranging here on the daily chart between 208, 209, and 212. So that's where you are in this range. But between 210 and 217, this is a stock that I like with this parabolic rise, trading at a 188 PE on a trailing 12 months. I think this is coming back down. I think it's coming back down a lot. But, again, this is going to roll the best or the heaviest once the NASDAQ actually rolls. NASDAQ goes up and down a couple hundred points. You could have some chop in here. So always be aware of that. NVIDIA, shared this one as well. I told you I got it at 274. At the time of this recording, it's 262, but we did get lower than that today. Actually, we got down to 250, 258. Yeah, 258. So NVIDIA is showing some weakness. You may get a little rebound up here for a double top as well. Lots of chop, guys. And just because an indice falls doesn't mean an individual stock will fall. Could have the inverse effect as well. So always be very choosy and selective of what you're trading and understand the reasons why. Why trade NVIDIA? Up 84% this year. Semis are very cyclical. Tech does horrible in recession. So again, depends on your market view. But I like this as a short potential at 267 and above. Okay, that's where I like it at. And now, of course, that trade is nicely in profit as well. So we'll see if this holds up. If it comes back up for a retest and then comes back down again, you're going to have some volatility in these assets. Tesla, I like Tesla a little bit higher. Like I said last video, it never got there. It got to 200. I liked it at 206. I think it was a 786 fib. It got to 200, but Tesla's selling off a little bit as well. Again, beautiful double top. You got to pay attention to these market structures. This is a heavily traded algorithmic stock as well. You have euphoric rise, retail buying the rally, smart money, big money dumping on you, retail buying the dip, big money dumping on you, and then you sell off. This is why Wyckoff tracks so beautifully for how money moves through the market, because you got dumped on here if you were retail and you did a level change from $300 to $100. And that's why these double tops form, because you get that euphoric rise, and then the algos, the smart traders, the whales will start selling. They'll fade the rally. They'll fade it. It gets bought up. You get a second attempt at a key resistance level. And what makes it a resistance level? Well, where all of the big money is selling. That's really what makes it a resistance level. And then you level change and they stack massive profits. Whereas a lot of people are sitting here looking at their phones. Man, it'll go back up. It'll go back up. This is not a bear market. So that's that. Let's go ahead and look at the last couple of assets here. Wrap this 3-hour video up. So now you guys understand, by the way, why I don't want to discuss every single price target, every single video, because people ask me all the time, well, do you not think we're going down anymore? Do you think we're going up? I can't cover every single thing, every video, guys. That's why it's important to try to keep up with the videos. I only make, 2-3 videos a week. So I highly suggest you watch them because I want to be able to cover new material. So again, gold struggling, hit 2000 twice, reject it all the way back down to whatever, 1944. Again, my thesis get up above 2055. If you just get a spike like you did in March of 22 or August of 20% moves. You got swing moves here of 20%. Get above 2055 if you're Livermore pivot, then I'm bullish on gold. But my personal thesis is this will move down 15-20% when the equities roll. I'll buy gold down there. Okay, that'll be below your 1600 level. So back down into the 1500. Silver, even more simple. Trend line been in effect for 2 years. Flip 24 spot 27. 24 spot 27 will get you up above the 786, and then I'm bullish. But as of right now, you printed a beautiful double top, got rejected to the penny at the 618 at 23 spot 48. So watch that. If the markets start rolling, this may be an asset that you can jump in on and have this thing fall down. All right, guys, that wraps it up. 43 minutes. I hope you had enough popcorn to get through this. I'll see you all next video. Take care, everybody. Happy trading.